Hi everyone, welcome back to the investment banking series. Previously, we have discussed uh, the basics, question number 1 to 10 of this lecture. So now we are starting with the other questions. Out of 34 questions, we will be covering question number 11 to 10, 20. So 10 questions in this video also. So let's get started without wasting any time further. So the question number 11, this is a tricky question where an interviewer actually asks a candidate the effect of changes in inventory on the income statement, which at times the candidate gets confused. So this is a common interview mistake, and at times what the candidate does is it states that the changes because the inventory is actually a part of changes in working capital. They get a misinterpretation that it is a part of income statement. But no, unless until any good is processed and sold, it doesn't becomes a part of income statement. For example, if we have $100 worth of inventory and we process it and we sell it for $200, then $200 will be our revenue and $100 will be our cost of goods sold. Unless until the inventory is not processed and sold out to generate revenue, we will not record it in the income statement. Yes, in the cash flow, the changes, addition or subtraction of inventory will be shown in the cash flow statement, but not on the income statement. So let's read out the explanation. This is a common interview mistake, incorrectly stating that the working capital changes show up on the income statement. In case of inventory, the expense is only recorded when the goods associated with are sold. So if just sitting in the warehouse, it does not count as a cost of goods sold or operating expense until the company manufactures it and into a product and sells it. All right, so let's move to the next question. I hope this is clear. So question number 12, question number 13, and question number 14. These three questions are linked. And for this, we will actually have to move to our Excel. So these are three questions on a same scenario. So here the question states that let's say Apple is buying $100 worth of new iPad factories with debt. So Apple is actually purchasing $100 worth of factory, $100 worth of factory with debt. In year one, they are purchasing $100 worth of factories with debt. So they are going to purchase factory. So investing activity, they are investing minus $100 because this is a cash outflow. But they raised that capital using debt. So there was no changes in inventory, no changes in cash and cash equivalent. So there was no changes in cash and cash equivalent. Understand this thing. No cash was generated because whatsoever debt they raised, they used that debt to purchase PP&E. And on the cash flow statement, it will look like this. On and the balance sheet, because we have purchased $100 worth of inventory in worth of PPE, we will record a set of $100 worth of non-current asset, fixed asset, and because this debt was raised, we will also have non-current liabilities debt of $100, and our balance sheet matches. Now let's move to the second question. Let's read the explanation for this. In the start of the year one, before anything else has happened, there would be no changes on the Apple's income statement. We have done seen that. On the cash flow statement, the additional investment in factories would show up under cash flow from investing as a net reduction in cash flow. And the additional $100 worth of debt raised would show up as an addition to cash flow from financing, canceling out the investment activities. So the cash numbers stay the same. And on the balance sheet, there is now an additional $100 worth of factories in the plant, property, and equipment line. So PPE is up by 100, and asset is therefore up by 100. PPE is up by 100, and asset is up by 100. That's what they are saying is PPE is up by 100, assets are up by 100, debt is up by 100, so liabilities are up by 100. Because total assets is equal to debt plus liability, debt plus shareholders equity, so the balance sheet is balanced. So this is done. Okay. So this was year one. Now let's move to year two. So now pay attention. I want your undivided attention for a few minutes. Just pay attention to this question. These three questions are linked and these are tricky questions. So you need to pay a little attention so that your concepts get clear. Now they are saying, assume that this is a high yield debt. So no principal is paid off. No principal is paid off. First condition. Second condition is assume interest rate of 10%. Second condition, and assume the factories deprecate at a rate of 10%. This is the third condition. So what will happen? First condition is no principal is paid, interest rate is 10%, and factories deprecate at a rate of 10%. Now let's go to the Excel and see what happens. Interest at 10% in the year two. Now we are working on year two. Uh, Interest is 10%, depreciation is 10%, and no debt is paid. This means this will be carry forwarded here also. That is, no debt is paid. Okay. And in the income statement, there is going to be a depreciation of 10%. 10% of PPE, it will be realized. Here it will be $10. $10 of depreciation. So this means the PPE will be reduced by 90 because of $10 in depreciation. Now, EBIT, I'm assuming amortization is zero. EBIT will be negative. So interest of 10%, we actually have to pay interest not on the EBIT, but on the debt. The interest is paid on the debt, not on EBIT. So the debt we have, I think it would make much more sense if we use I-19 from the balance sheet. This, not I, J19. So we have paid an interest of $10. So to earnings after interest. So we have paid a depreciation of $10 here, and we have paid an interest of $10 here. So total we have paid $20 of interest, and this has caused us, because of tax deduction, the net income is now down by $12. And this will be reflecting here also. So the second condition was no debt was paid. Okay. Interest 10% and depreciation 10%. Now pay attention. 10 Now we actually have to adjust the cash flow statement for the non-cash depreciation, changes in non-cash of depreciation. So We have added back the depreciation here because we subtracted depreciation here. We have added back it here. And what else can we add? There is the cash was down by $2. We have to link the change in cash here. And this way, our balance sheet is balanced now. See, it was relatively very simple because we have not. Okay, I understand that it might be confusing because we are only looking at the changes, whatever happened, not the whole income statement and the balance sheet and the cash flow. We can plug in hypothetical numbers here and we can see how does it goes. But as of now, just trust me and trust the process and just let's read what the explanation says. So after a year has passed, Apple must pay interest expense and must record the depreciation. Operating income would decrease by $10 due to $10 depreciation, and $10 in additional interest would decrease the pre-tax income by 20 altogether. So like we have seen $10 and we have seen that $20 by the pre-tax income was decreased by $20. Let me just share the Excel one more time. So the net income was decreased by earnings after interest. So the pre-tax income was decreased by $20 here. And because of tax, the net income was decreased by $12. Because of tax, the net income, because you at 40%, net income will fall by $12. Okay, we have seen this much part. Now in the cash flow statement, net income, because it is linked, net income is linked to the cash flow statement, $12. Depreciation and non-cash expense, we added it back. So the operating expense is down by $2. Cash flow from operations is down by $2. And there, that's the only change in the cash flow statement. So overall cash is down by $2. So overall cash will be down by $2 and that's it. Now let's again see. Net income will be linked from here to here. Depreciation added back. Cash, because the net income has fallen by $12 and depreciation was only for $10 and because of interest also. So the difference, this is a negative. So there was a negative -2 of cash outflow. And because of that cash, we have a cash outflow of -2 here also. So it is linked to the balance sheet. Now the third part where we were looking at the balance sheet. On the balance sheet asset, cash is down by $2 and PP is down by $10 due to depreciation. So overall asset are down by $12 here also. On the other side, net income is down by $12. Shareholders equity is also down by $12. Both side balances. Okay. And as of now, we have understood that net income is linked to shareholders equity here and net income is linked to uh, cash flow statement, net income here. And this will be linked after paying dividends because after if we are paying dividends, the retained earning will only be linked here. If there is dividend, this number will change. So out of -12, which is a loss, if it was a positive number and we have paid, for instance, 10% as dividend, the rest of the money will be accumulated here. So in balance sheet, $2 of cash is cash outflow, $10 worth of depreciation has reduced the PP by $10 and nothing else. This is a change of -12 and this here it's also change of -12 and this is actually balancing our balance sheet. All right. So I hope this was clear. This was the trickiest part. Now the third question, which is little more tricky. So just pay attention. This after third question, the other questions are relatively easy, but the third question, question number 14, the year three, at the start of year three, all the factories broke down. So all the factories are actually, and all those, the money which we have paid for the factories PP, the PP value of PP is now zero, and it will be written down to zero. The loan must be paid back now. Walk me through the three statements. Now, if this kind of, see, on paper it is easy, and to calculate in the, when you are somebody is verbally asking you and calculating inside your mind, it's difficult. So you actually have to be very clear when you are thinking about it. So at the start of the year three, the all the factories break down. So at the start of the year three, all the factories are breaking down, and the value is 80, and the depreciation would be $10. All right. Second, written down to zero, the loan must be paid back. Walk me through the three statements. Now, because the factories are at the year end, they were $80, $10 depreciation we are assuming. First, on the income statement, we will write down $80 on the income statement. And there I have written $80, or there is a provision for write down also. So I'm writing down $80 here. So if I'm writing down $80 here, so my net income after tax will fall drastically. The net income will fall drastically. The net income will decline to, just give me a moment. So the net income, we will link it back to the net income will be linked here. And just give me a moment. Just let me just figure it out. And So because we are writing it down this year, we will not account depreciation. So this is the first part. We will not account depreciation because we are now writing it down. So everything is written down. So this amount, we have written down the whole amount. This means next year the property PPE will be zero. So we do not have to we do not have to account for depreciation this year, and this will cause a $48 decrease in the net income. So, and also the this net income is actually will be a part of cash flow statement. So writing down because we have written it down. We are writing it down because the factories have broken down, but there was no cash outflow. So this $80 is within us only. So we are writing down, then we are adding it back because this is a non-cash expense, and because of this, the statement, the I mean, because of this, there was a change of cash, $32 worth of cash. There was an inflow. So this will be added back here in the income statement, sorry, in the cash flow statement. And one again, the $100 worth of investing activity, we will actually have to subtract it from here. So the liabilities, we actually have to account for this only, this also here. So total liabilities will be just so on the balance sheet, and this $68 of, I mean, then the cash is down by $68. So the third question is kind of little tricky. So what I wanted to tell you is, okay, so the income statement there, the $80 worth of write down was a pre-tax income. So because this is written down, so this will decrease our earnings by from minus 20 to minus 70, earnings after interest, the pre-tax income. And with a tax rate of minus 40%, it will be minus 28. The net income will be minus 42. So there will be a loss of minus $42, which will be reflected in the net income. So here the net income will be linked here because write down will be added back. There will be a cash flow from operations of $38. And because there is a write down, if we are looking at the cash flow statement, let's see, there was the PPE investing of $100 and the debt was raised $100. Invested, raised and invested. But because the factories are not broken, so this $100 will be now the debt will be this debt has to be repaid. So this will be minus 100 and this will cause a cash outflow of minus $62. This cash outflow of $62 will reflect here in the cash and cash equivalent. And because the PPE now we actually have to remove it from our balance sheet, we will subtract minus $80 worth, which was the $80 worth of PPE is now broken. So the we will write it down in the balance sheet also. The from $90 that then we will not deprecate anything. So $80, this was the this was the real time value of the property. So it we will write down the PPE from the balance sheet and the current value, the debt will be written off. The debt will also be written off, and this will balance the balance sheet. I will share the Excel for the reference. I have put in the formulas everywhere. So whosoever will be available, they can look into the formulas and they can check everything, how the Excel is moving. This is a very basic Excel, linking everything. So this was actually, these three questions are actually the most tricky questions. Scenarios for year one, two, and three. So if these kind of questions are asked, so okay, let's go through the reading. So go through the explanation first. After 2 years, the value of the factory is now $80. So if we go to the 10% depreciation per year assumption, it is 80% $80 that we will write down in the three statement. First, on the income statement, $80 written down show up in the pre-tax income with a 40% tax rate. Net income declines by 48%. So here the net income is actually declining by 48. 48. How's that? All right, we will not be paying any interest. This might have been mistakenly added here. So because we are writing it down, so we will not be paying any depreciation. We will not be paying any amortization. Sorry, we will not be paying any no interest, no depreciation, because everything is now being written down. So the net income is minus 48. So minus 48 will be plugged in here, and this will create a $32 surplus because we are adding back the write down. But the write down is a non-cash expense, so we will add it back, and therefore the cash flow from operations decreased by 32. The cash flow from operations will decrease by 32. There will be no changes in the cash flow from investing, but under cash flow of financing, there is a $100 change in loan payback. So financing, because we have financed, we actually have to pay it back. So the financing activity, we will actually have to pay it back. So this $100 of debt, we will actually have to pay back. And because of that, there will be a cash outflow of $68. Overall, net change in cash falls by 68. On the balance sheet, the cash is now down by 68 and PP is down by 80. So asset has decreased by 148 altogether. So now the asset has fallen by 148 altogether because there's a decrease of $68 of cash and there is a decrease of PPE by 80. So $148 of cash and the liabilities, we will write it down. So $100 of liabilities are written down and the shareholders equity, which was linked from here to here, the 148. Now the balance sheet is balanced. This is a tricky question. Just go through the recording one more time or twice and you will understand how things are linked or read the explanation by pausing the video. This is these three questions are very important and these are the trickiest questions. All right. So let's move to the next question. So if now the question is asking, now let's look at a different scenario and assume Apple is ordering $10 worth of additional iPad inventory using cash on hand. They order the inventory, but they do not have manufactured or sold anything. What happens in the three statement? Now we know that unless until we have discussed it previously also, unless until we will manufacture and sell it, we will not record anything on the income statement. So cash flow statement inventory will be up by $10 and the cash flow from operations will decrease by $10. Why? Because this is an outflow, cash outflow. So there will be no further changes. Cash is down by $10. On the balance sheet, inventory is up by $10 and cash is up by $10. So this is relatively very easy as compared to the previous three questions. All right. This was easy, I think, and let's move to the next question. So next question is in continuation to the previous question. Now let's say they sell iPads for revenue 20 at a cost of 10. Walk me through the three statement. So this we have discussed and like similar to this we have discussed an example earlier also. So $20 is revenue, $10 is cost. So the gross margin will be $10. And operating income will be 10, assuming a 40% tax rate. Net income will be 6. In the cash flow statement, net income will, the cash flow statement will start from net income. Inventory has decreased by $10 because it was a cash outflow, which is netted to the cash flow. So the cash flow is up by 16. And there are no other changes. So cash is up by 16. And on the balance sheet, cash is up by 16 because the closing balance is linked with the cash and cash equivalent of the balance sheet. Inventory is down by 10 in the balance sheet. So assets are up by 6. 16 minus 10 is 6. And on the balance, the other side, the net income was up by 6 and the shareholders' equity is up by 6. Both sides balanced. Okay, let's do one thing. If this is difficult, no, I don't think that there will be any difficulty. If you find this question difficult, just post it in the comments and I will make a video using the Excel for this question. Question number 16th, episode 2. So let's move to the question number 17. So the question number 17 is asking about shareholders' equity. Can it be negative and what does that mean? And shareholders' equity, yes, shareholders' equity can be negative because of leverage buyout with dividend recapitalization. It means that the owner of the company has taken out a large portion of equity, which can sometimes turn the numbers negative. Yes, the shareholders' equity can be negative. There are two cases, leverage buyout with dividend recapitalization, and it can also happen when the company has been losing money consistently and therefore has a declining retained earning balance. We have seen that in case of Apple also. So Apple actually, not shareholders' equity, but Yes. Shareholders' equity is not negative. This can only be negative in two cases. And this is for Apple. They are asking about the shareholders' equity. Shareholders' equity can be negative if there was a dividend leverage buyout using with dividend recapitalization or declining retained earning balance, which is a portion of shareholders' equity. If this component of retained earning is bigger, then if the company is continuously making losses, in this number 17607 is I don't know 17607. So in that case, this number will be more greater than the total shareholders equity. And that case, if the company is continuously making loss, then it will be a negative shareholders equity or dividend recapitalization using leverage buyout using dividend recapitalization. So these are the two cases. We will discuss about dividend recapitalization after some time in the LBO section. Okay, so I think we are clear about this. Let's okay. So question number 18, what is working capital and how it is used? So working capital, the basic formula of working capital is current assets minus current liabilities. And we have seen in the cash flow statement previously also, working capital changes are here. Changes in operating asset and liabilities, these are the changes in working capital in the cash flow statement. If it's positive, it means the company can pay off its short-term liabilities with its short-term assets because we are subtracting current liabilities from current assets. If assets are more, then it's a positive number. If assets are less, then it's a negative number. If assets are more, this is going to be a positive number. If current liabilities are more, then it's going to be a negative number. So if we have more assets, then we will be able to pay our short-term liabilities. If we have more liability, then we will not be able to pay our short-term liabilities. If it's positive, it means a company can pay off its short-term liabilities with the short-term assets. If it is often presented as a financial metric and its magnitude and sign tells you whether or not the company is sound. Bankers often look at operating working capital more commonly in models, and that is defined as current assets minus cash and cash equivalent and current liabilities minus debt. So cash and cash equivalent, the most liquid, and the current liabilities, the debt we remove. Then we look at the operating working capital. This is the formula for operating working capital. The point of operating working capital is to exclude items that are related to the company's financing activities. Cash and debt from the calculation. Okay, so financing activities can impact the cash and cash equivalent and debt. That's why we are removing those. And then we are looking whether or not we will be able to support our working capital requirements. Okay, so in question number 19, let's move to question number 19. What does negative working capital mean? And is that a bad sign? So, working capital, like we have previously, working capital is current assets minus current liabilities. So, it being negative, is that a bad sign? So, not necessarily, it depends on the type of company and the specific situation. Here are few different things it could mean. Some companies with subscription or longer term contracts have often negative working capital because of high deferred revenue balances. Okay, for instance, let's take talk about Netflix. So Netflix has a annual subscription of assume $100. So the deferred revenue component of Netflix is going to be more. So in that case, the deferred revenue component will be a part of deferred revenue will be a part of current liabilities. In this case, the current liabilities portion will be greater than current assets. So it depends on company to company. It depends on the business model whether or not negative working capital is a bad sign or not. Like retail restaurants, companies like Amazon, Walmart, McDonald's have negative working capital because the customers pay upfront. So they can use the cash generated to pay off their accounts payable rather than keeping a large cash balance on hand. This is a sign of business efficiency also. Yes. Understand this thing. If you are a Domino's Pizza or you are running any restaurant or a quick commerce website or quick commerce joint where you are customers are paying you upfront in cash, then there is no requirement of cash payable because the moment you get the cash, you will pay your account payables. The moment you get the cash, the business cycle will be very small in these cases where the business is making quick cash. So in those cases also, the working capital gets negative. Working capital because customers pay upfront, so they can use cash generated to pay off their accounts payable rather than keeping a large cash in hand. This can be a sign of business efficiency, yes. In other cases, negative working capital could point out financial trouble also and possible bankruptcy for the when customers don't pay quickly and upfront and the company is carrying high debt balance, yes. So it depends on business to business and that depends on the company's business model, how the business is being run. So by looking at the working capital, negative working capital, you cannot make any assertion. It could be bad, it could be good, or it might not be relevant. But you actually have to look into the business model of the company first. 20 question number 20. Let's talk about question number 20. Recently, banks have been writing down the assets and taking huge quarterly losses. Walk me through what happened on the three statement when there's a write down of $100. So we have seen these kind of questions earlier also. First on the income statement, $100 write down means pre-tax income line, 40% tax rate, 40% tax rate, net income will decline by $60. Let's look at the Excel. Uh, the write down, uh, let's use this column one. And I don't think that it's now needed any of this data. I'm not removing the formulas, only the numbers which I have plugged in. So there is a write down of $100. And because $100 is write down, there is a write down of $100. Okay, so there was no formula here. Because there is a write down of $100 at 40% tax rate, the net income has fallen by $60. Yes, net income has fallen by $60. Correct. This is what the answer is stating. On the cash flow statement, net income is down by $60. But the write down is a non-cash expense, so we add it back, and therefore the cash flow from operations increased by $40. Yes, because write down is a non-cash expense, we will actually write it, add it back here, and because of this, there is a cash inflow of $40. And we actually have to link cash and cash equivalent here. Now, and this net income, we will have to link it here in the accumulated deficit. So, $40, there was a net change in cash rise of 40. On the balance sheet, cash is now up by $40 and asset is down by $100. Asset is down by $100. Cash is up by $40 and asset is down by $100. It is not clear which asset. Overall asset side is down by $60. So I am assuming PP again. So PP is down by $100. So this actually balances our balance sheet. And this was, everything is matching now. On the balance sheet, $40, an asset is down by $100. Overall, the asset on the other side, since net income is down by $60, shareholders' equity is also down by $60, and both sides balances. So here also, net income is down by $60 and retained earnings because it is plugged in retained earnings. So it is also down by $60. So this balances our balance sheet. So this is the end of session 2, episode 2 of the investment banking series. In the next episode, we will start with question number 21 onwards to question number 30. So if you have learned anything of value today, kindly subscribe to my channel, and thank you. Thank you for your time.